Good morning, ladies and gentlemen, and welcome to today's webinar on overview of corporate tax in UAE, basis the public consultation document. My name is Lydia Wummel-Tiagi, and I'm working as an executive director with MBG Corporate Services, and it is my immense pleasure to host this webinar today. I believe the high number of attendees today shows the interest in today's topic, and I'm very delighted that we have three of our experts who will address today's topics and surely will provide us some insights on corporate tax. We have Mr. Amit Sachdev, CEO, Direct Tax, which I would like to welcome for today's discussion, along with Mr. Manoj Pandey, who is the COO, Direct Tax and head of our Abu Dhabi office, and Mr. Vinit Gala, who is the senior manager on Direct Tax. You are all very much aware that the Ministry of Finance has announced the introduction of 9% federal corporate tax in the UAE on business profits with a threshold limit of AED 375,000. This comes into effect from financial year beginning 1st of June 2023, but I believe today we will learn that a lot of preparation and implementation has been done way before this. So based on the public consultation document, as well as our international experience in international markets, our experts will give us today insights what can be expected from the new corporate tax regime. So let us have a look at the agenda for today. I will give a very short introduction about MBG Corporate Services for all of you who don't know us yet. Then I will hand it over to Mr. Amit Sachdev, who will give us a genesis of UAE corporate tax. Then we will hear on learning from global tax practices, key provisions of proposed corporate tax regulatory framework, and an overview of much more than 9% on net profits. So for all of you who don't know us yet, I'll just give you a brief introduction. MBG Corporate Services is headquartered in Singapore with currently 18 offices spread across 8 locations in China, Japan, India, Germany, Qatar, Oman, and here in the UAE, we have more than 300 professionals based out of offices in Abu Dhabi, Dubai, and Sharjah, working with more than 3,000 clients, out of which more than 100 are Fortune 500 companies. Overall, the group employs 600 plus professionals, as I said, 300 here based in Middle East. Of course, our team comprises of various diverse workforce and professional expertise across state orders, qualified chartered accountants, tax experts, where we have some of them present for today. When it comes to the services we are providing, actually we are providing services at every stage of a company's life cycle. So even before they come here, we do feasibility study, market entry support, company formation, across the entire life cycle up to extension and liquidation of entities. This we do with 8 in-house service verticals, the traditional audit and assurance practice where we provide stat audit support for mainland and free zone entities. Also, we are extremely proud that we are one of the certifying partners for the National In-Country Value Program. In terms of risk advisory, we provide support in terms of standard operating procedures, internal audit, up to enterprise risk management. We are a registered tax agency with the Federal Tax Authority and support across VAT, excise, and customs. Also, we are extremely well versed and prepared for corporate tax, and since many years we have been working on cross-border and direct tax implications. In terms of M&A, we support both on buy side as well as sell side. We have an in-house legal team. We provide strategy and transformation advisory, and we have an in-house technology advisory team where we support our clients in terms of IT audit, cybersecurity assessments, or even robotic process automation. When it comes to our sector experience, we generally work sector agnostic, but of course we have subject matter experts which we are deploying based on the industries which are present here in the UAE. Before I would like to introduce our speakers, you must have all seen that there is a question and answer box at the bottom of the screen. So we encourage you to drop any question and answers either in this box, which we will either address live today or post this session. So with this, it is my privilege to introduce Mr. Amit Sachdev, who is the CEO, Global Knowledge Leader, Corporate Tax and Legal Consultant. He has more than 22 years of post-qualification experience in a range of areas, including tax laws, accounting, foreign investment, foreign exchange control regulation, and corporate and business law. As a practicing professional, he has worked and advised large number of global corporates, has worked with many multinational conglomerates in a wide range of industry. With experience in international tax and cross-border transactions, he's extensively involved in advising corporates on inbound investment tax regulatory matters. Mr. Sachdev, we are looking forward to hear your insights. Over to you. Thank you.
Thank you, Ms. Lydia. A very good morning to all of you. I'm quite delighted to have such a large audience in this webinar, and I'm also quite thankful to everyone for sparing their valuable time out of their busy schedules in attending this event. It's quite overwhelming and speaks about your curiosity about corporate tax. I'll very briefly touch upon the genesis of proposed corporate tax regime, as we call it CT in short form, along with few important learnings practicing corporate tax in other overseas tax jurisdictions. As you may know that it was on 31st of January, the Ministry of Finance UAE announced the introduction of federal corporate tax on business profits. This pronouncement, of course, followed an issuance of a consultation document in which business communities and stakeholders were asked for their comments prior to release of the CT law. Needless to mention that this act in itself demonstrates government's quite participative approach in ensuring an environment which is conducive for trade, business, and investments in UAE. UAE, as a member of Inclusive Framework of Organization for Economic Cooperation and Development, we call it OECD for short, is introducing the federal CT regime to fulfill its commitment to the global minimum effective tax rate concept, which was proposed by Pillar 2 of OECD Base Erosion and Profit Shifting Project. So it's an commitment to ensure a minimum tax regime prevails in UAE. The public consultation document makes a mention that Federal Tax Authority will be designated as an administrative and enforcement authority for implementation and supervising the CT regime in UAE. Implementation of CT regime follows various other regulatory reforms in UAE in past few years, which includes introduction of VAT, reportings by way of ESR, amendments in visa norms, changes in few corporate laws alongside some new legislations, which is nothing else but an assurance of building up a robust regulatory framework in UAE by the government. The proposed CT regime incorporates best practices and principles that are internationally known and accepted. Lydia, you can turn to the next slide, please. And the government, very interestingly, has refrained from introducing any new concepts aiming an easier transition and also minimizing compliance burden for the businesses. The proposed law retains majority of direct tax benefits of the UAE, such as benefits given for employment income, personal income earned by UAE and foreign individuals. It also promises concessions and incentives to the free zone entities, subject of course to certain conditions. Likewise, exemption on dividend and capital gain also has been retained. So this in itself also ensures a very visionary and commendable approach of the nation's leadership for creating and building a promising, stable, and growing economy, maintaining its attractiveness for foreign investment. It merits mentioning that sufficient time is also being given to business community in their readiness journey, in carrying out an impact analysis and plan their actions, decisions, including reorganizations of their corporate structures, to avail all the concessions and exemptions which are proposed under the corporate tax legislation. My colleague, Ms. Lydia, mentioned about the taxation limits and the rate. Interestingly, the law here proposes a progressive taxation whereby net profits in excess of AED 375,000 shall be taxed at 9%, which means you'll have 0% tax rate up till an annual income of 375,000. Anything in excess shall be taxed at 9%. And profit here would mean accounting profits, which will be calculated by following the international accounting standards or the best practices in computation of business profits. Any business which is having a foreign branch outside UAE shall be permitted to claim credit of income taxes which are paid in foreign jurisdictions, subject to certain conditions to prevent any amount of double taxation. And businesses which are having multiple entities are permitted to form a tax group, which will be considered as a single entity for ease of compliance and reduction of administrative burden. And there is no requirement to pay corporate income tax in advance or make any kind of provisional filings. Businesses will have to file one tax return and will have to make payment of tax in one installment itself. Practicing the law in other countries, I have listed 3 or 4 important pointers which will be quite helpful for businesses to plan their corporate tax compliances and their readiness journey. Point 1, I strongly feel that all businesses should be keeping all proper records and they should have sufficient documentation to support all the disclosures and the reportings which are being done in corporate tax return. Businesses should also plan their transactions with related parties, connected persons in compliance with criteria of arm's length pricing principles, which means any transactions between related parties, connected persons, related enterprises should have to meet the arm's length criteria. Means there should not be any influence on the pricing parameters of any transaction between such enterprises. This is something which we call as transfer pricing regime, and this is very, very common in all global mature tax jurisdictions. Simultaneously, every business must plan their compliance obligations in very timely and accurate manner. Fortunately, as I mentioned, the compliance obligations are quite minimum in this law. So you should be very, very clear as to how you plan your affairs. Simultaneously, there should be separation of business and non-business expenditures to ensure the admissibility of all these expenditures while computing taxable profits. Any transaction which is quite personal in nature, which has some element of personal mandate, should be ignored to be recognized and claimed as expenditure, as this will be disallowed. My colleagues Vineet and Manoj will deal in detail about the corporate tax regime, and they'll present you some important aspects and insights in the law as flows out of the public consultation document. And our team certainly shall be quite helpful and shall be quite pleased to assist you in planning your transit to CT regime. I once again thank you for your participation. Over to you, Vineet. Thank you very much. And good day to all of you.
Thank you so much, Mr. Sachdev, for giving us these insights. I would like to introduce Mr. Vineet Gala now, who works as a senior manager here in the corporate tax team. He's a qualified chartered accountant with more than 7 years of post-qualification experience, which includes more than 2 years of GCC experience. He is an expert in international tax and transfer pricing, and he will take the session forward now. Mr. Vineet, over to you.
Thank you, Lydia, for the introduction. Once again, a very good morning to each and every person present over here. The proposed corporate tax, or we say a direct tax in UAE, brings about the salient features which are more aligned with the international concepts, and we do not expect and we do not see, as it is from the public consultation document, any new concepts, so thereby aligning to the global best practices. We will quickly go through and touch base upon each and every finer aspects, starting from the taxable persons, who are the national persons or legal entities or the exempt persons, how the scope of total income is defined, the tax residency, and also we touch base upon exemptions and tax deductions or express tax disallowances, etc. Yeah. So we start with the taxable persons and the natural persons. Maybe we have the next slide, please. So when it comes to the taxable persons under the UAE corporate tax regime, we bifurcate or we segregate into three buckets for natural persons, legal entity, and the exempt persons. As far as natural persons are concerned, we do not have any new surprises as far as our personal incomes are concerned. So our employment income or the employment income or the return on investment in our personal capacities, those are not going to be within the scope of UAE corporate taxes. However, in case an individual or natural persons like you and me have a business income, we are doing any business in the UAE, we are in scope of the corporate income tax in the UAE. So yes, any business or commercial activity in the UAE of individuals or individuals doing any business under the sole establishment or proprietorships, and then the partners or the members of the fiscally transparent entities would be in scope of the corporate income taxes. Now coming to the point of some important deliberations. Rahul, maybe you have the previous slide, please. Coming to the important deliberations, the requirement to have a business license is a key to determine whether the business activity or the commercial activity is within the scope of UAE corporate tax. So good amount of family office setups which we see in the UAE may have to assess each and every activity which are now under the umbrella of the family offices to see whether any license requirement is there or not. May we have the next slide, please? As far as the legal persons are concerned, it follows the approach which is internationally known of a distinct entity. That is an entity which is set up having under the entity which is set up under the laws of the nation and having a distinct entity. So as far as domestic entities are concerned, legal persons include entity incorporated in the UAE and having a separate legal status. And there are final printout for a limited or other partnerships where the liability of the partners is not unlimited. Of course, there are some conditions, there are circumstances under which the limited or the partnerships fall under the category of the domestic entity or the legal person. However, interestingly, when it comes to the foreign entity, again, we are aligned with the source-based concept, which is internationally followed. Any entity having source of income in the UAE or having the permanent establishment in the UAE would be in scope of the UAE corporate tax. And two interesting points here. One, as foreign entity having the place of effective management in the UAE, and the foreign unincorporated partnerships in certain conditions or circumstances would again be in scope of the UAE corporate tax. And then the filing of the return of income will follow and other compliances will follow. Coming to the important deliberations, source-based taxation has been envisaged at large. So the payments from the UAE, which would be now going to the foreign nations or to the foreign entities, would now be under the scrutiny. And interestingly, right now we have a 0% withholding as proposed under the public consultation document without having any compliance requirements. So how the government tracks those payments, how the enforcement is around the source-based taxation, etc., would now be under consideration. Maybe have the next slide, please. Coming to the exempt persons, there are 5 categories carved out as far as exemptions are concerned. And very much point to be noted is the exemption may be automatic or exemption might be by way of an application before the government, which would be approved or which would be disapproved if certain conditions are not met. So starting with the federal and emirate governments and their departments doing any non-commercial activity, a clear exemption has been carved out. With the condition that in case any government offices is doing any commercial activity under any trade license, then they might be under the scope of UAE corporate taxes. A similar approach has been for a wholly owned government companies engaged in sovereign or mandated activities. What are sovereign or mandated activities we expected to be part of the corporate talk, well defined, etc. So only when the activity falls under any sovereign functions or mandated activities of a wholly owned government enterprises, those would be exempted from the corporate income taxes. Coming to the entities engaged in extraction and exploitation of natural resources. As it flows, we do have income taxes prior to the federal level corporate taxes, which is recently announced. Those corporate taxes were at the emirate level. Each emirate within the United Arab Emirates had a different law, specific law to tax the entities engaged in the extraction and exploitation of natural resources. Those law might continue, and the entities who are there in the extraction and exploitation of the natural resources would be continued to be taxed at emirate level. An interesting point would be the exemption again is not a blanket exemption over here. The exemption applies to a primary or a main concession holder who has a right to extract and exploit the natural resources. In case you are a subcontractor, again, having contract with the main like concession holder, then you are in scope of the federal level UAE corporate tax. Coming to the charities and public benefit organization, the policy, as it seems right now, the government wants to encourage some cultural activities, religious activities, some social causes. So exemptions have been proposed for charities and a public benefit organization. Again, the benefit is not a blanket benefit. You do not have to be involved in any commercial activity which are not part of your main object, and the activities should not be benefiting any specific class of persons or specific group. Only then the exemption would prevail. And coming to the investment funds, again, as the audience might be aware, UAE has been one of the international financial centers having a good regulated framework as far as financial sector is concerned. Classic example would be the DIFC free zone, which have a much regulated framework around the financial transactions and an internationally aligned concepts and regulations around it. Another example would be the Abu Dhabi Global Market, ADGM as we call. So the government has recognized the importance of the financial sectors, growth-oriented approach, etc., would be there in place for some investment funds subject to certain conditions. If we fulfill those conditions, the exemptions would be there if we qualify as an investment fund. May we have the next slide, please? Coming to the concept of tax residency, here we need to understand why a tax residency is a very important consideration. The scoping of the total income, or in other words, or in layman terms, which incomes would be taxable in the UAE would then be dependent upon the residency status of a national persons or an entities into the scope of total income would then be dependent upon the residency status of the national persons or the legal entities. I think there's some sound issue. I will just excuse for 2 seconds. Hello. I hope now the voice would be clearly audible in case you had faced some issues around the voice. Yeah. Coming back to the topic of tax residency. The way we discussed tax residency again is an important concept for determining the scope of total income. The category divides into residents and the non-residents. Residents, as far as legal entities are concerned, are the ones who are incorporated in the UAE. And the national persons are concerned if they are engaged in any business or commercial activity in the UAE. And as far as foreign entities who are having a place of effective management in the UAE, even they are considered to be the resident of UAE. A very interesting point when it comes to the national persons engaged in business or commercial activities in the UAE. In case a national person who is not a regular visitor or physically present, but qualifies as a resident for visa purposes, having a resident visa, regularly coming and visiting UAE for business purposes. Now, under the laws as proposed, he would be a tax resident if at all any business activity is carried on. But back in the home country, he might also be the tax resident of that country, following the tax laws of that country. An issue might arise of the dual residency, and then the risk of double taxation may be there. Some amount of clarity is definitely expected in the finer prints when the decree law and the executive regulations are published. And of course, we will also have to check the tax treaty provisions in case that dual residency is met, and how the tax tiebreaker rules around the residency works. However, as far as the non-residents are concerned, the definition is kept simple. The ones who do not qualify as residents would be considered as non-residents. Maybe have the next slide, please. Coming to the scope of total income, the way we discussed, it follows from the tax residency. When we qualify as a resident, our worldwide income would be subject to tax in UAE, subject to few exemptions, which we will discuss in slides to come. However, as far as non-residents are concerned, only the income which is attributable to a permanent establishment in the UAE would be then taxed in UAE, or the income which are having sources in the UAE would then be subject to tax in UAE as far as non-residents are concerned. Subjects such as permanent establishment or sources in UAE, etc., are a matter of fact. Sometimes it might become a complex issue when it especially comes to a permanent establishment. So all these factors have to be considered in mind. A clear risk-based analysis will have to be made right before the corporate tax comes in effect, especially from the place of effective management, from the permanent establishment, etc. And when it comes to what defines a source of income in UAE, as it flows from the public consultation document, a clear guidance is then awaited. However, some finer prints have also been classified or have also been documented to state what qualifies as a source of income in the UAE. Some example, like an income which is earned from a resident in UAE, from the assets which are located in UAE, etc., would then be qualified as having a sources in UAE. And interestingly, the same concept would then also be applied for a free zone entity having income sources from the mainland. So what qualifies as a mainland source income would again follow the same principle, which we would be discussed in the ensuing slides. Maybe have the next slide, please. Now we come to the special considerations and some interesting concepts around grouping. This is also an internationally known concept in many of the jurisdictions around the world, where a subject or where a concept of single taxable person is envisaged, in case many entities are present in the same countries, where a consolidation is permitted, etc. A basic concept, if you're having more than 1, 2, 3 entities, etc., and you are having a special purpose vehicle for each type of businesses, etc., only from a business objective, but you would mind to form it a tax group and only a single taxable person, then that is permitted subject to certain conditions. Interestingly, the compliance burden also reduces because a single return of income would then be applicable in those cases. Coming to the conditions, which is very interesting because it differs from the concept which is there in the VAT provisions as well. The first condition for forming a tax group would be the minimum shareholding and voting rights to be at 95%. The second condition is none of the group members can be an exempt person or a free zone person benefiting from a 0% corporate tax rate. The third condition would be the concept of full consideration for tax purposes. The fourth condition would be the mandate for having a consolidated accounts and the same fiscal or accounting years. So all these conditions have to be strictly followed, and only then a group can be formed. Now coming to the important deliberations, where can the group be formed, or what happens when a group cannot be formed, or when we have a multiple entity, if we are having a free zone entity benefiting from a 0% corporate income tax, what happens there? The way it is worded in the public consultation document, times will say whether a cherry picking would be allowed or not. Second, tax group, which has a different concept, lenient concept, I would say, under the UAE VAT laws, may have to be reevaluated. And what happens to a foreign branch, a branch which is there directly held by a headquarter, which is a non-resident? Can it be formed under a group or not? Those are still the open questions to be answered. And it's expected to be clarified in the decree law and the executive regulations. May we have the next slide, please? Some of the other concepts around the tax grouping would be the transfer of business losses and the group relief in case of some M&A or restructuring exercises. Now, take a simple example. In case we do not fulfill any conditions or the organizations do not want to form a group, what happens in that case? Again, a finer concept of transfer of business losses with some lenient conditions, wherein one group entity can transfer its losses or surrender the losses in favor of another group entity. The primary conditions around transfer of losses would be minimum 75% of the common ownership, vis-a-vis 95% of shareholding and voting rights envisaged for grouping purposes. However, there is a condition that in a particular given tax year, only 75% of the taxable profits could be set off against the losses. Now, what happens to the balance 25% of the losses? It can be then carried forward to subsequent years to be kept for an infinite period, the way it is worded right now. So this is concept around the transfer of losses. Now, when it comes to the group relief, and a very much planning exercise, etc., could be envisaged over here. It goes from the transfer of assets and liabilities in case of some restructuring exercise or a restructuring exercise per se, where we have some amalgamation, demergers, carve-outs, etc. These transactions are going to remain tax neutral. However, likely the transactions or arrangement likely should be within the UAE group entities. And there's a minimum lock-in period proposed as 3 years, so that, there are no abuse of the provisions and no unintended benefit which is passing on from a restructuring perspective. So a good planning tool in case organizations have already started talks for a reorganization or restructuring, etc. May we have the next slide, please? Coming to the exemptions, primarily the exemptions talk around 3 aspects, that is dividends, capital gains, and the profits of the foreign branches. Talking about the dividends and capital gains, a very welcome step as far as the propositions are concerned. As we read out from the public consultation document, the UAE government is going to arrange a holding structure regime in UAE with a balance with non-intended benefit for a double non-taxation. Talking about the dividends, we can divide it into 2 parts: the domestic dividends, or dividends which is earned from an outside jurisdiction, for example, KSA or any other country like UK, India, etc. As far as domestic dividends are concerned, those are going to remain tax-free, thereby avoiding the economic double taxation, because these entities might already be paying tax on the profits. So when these profits are distributed to the shareholders, they are going to remain exempt. However, when it comes to the dividends which are earned from foreign jurisdictions like UK, KSA, India, etc., a criteria of participatory exemptions would then be applied. In our knowledge and in our opinion, the conditions have been kept at minimum. First condition would be the minimum shareholding of 5%. And the second conditions would be the foreign entity should be subject to tax or an equivalent tax at least at the rate of 9%. So a very welcome step as far as taxation of the dividends are concerned, to avoid economic as well as jurisdiction double taxation, with a balanced approach for having an anti-abuse provisions in terms of participatory exemptions, and to avoid the cases of double non-taxation. Can we have the next slide, please? Yeah. When we talk about the capital gains, again, a similar concept. The provisions are holding company friendly provisions with an anti-abuse provisions to avoid double non-taxation. Here we divided into 3 categories. The gains which we earn from a UAE mainland companies, and the gains which we earn from selling of the shares of the entity in other jurisdictions like KSA, UK, etc. Those profits, if at all there's a gain from the selling of the shares of those entities, would be subjected to the participatory exemptions, which are similar, like 5% minimum shareholding, and foreign entity should be subject to tax or equivalent at 9%. Interestingly, when it comes to the free zone entity, and we believe it is catering to the offshore entities and offshore free zones, etc., which we see in practical day-to-day life. When we sell the shares of the free zone entity, that free zone entity should qualify as a holding company, and the substantial income of that holding company should be from an entity meeting the participatory exemption, which are again the 5%, and the foreign entity subject to tax at least at 9%. What qualifies or what defines as a holding company for free zone purposes? What defines the substantially all its income, etc.? Much of clarity is expected in the decree law and the executive regulations. However, interestingly, where we have an outbound holding structures, where the UAE entity has an outbound investment in other low tax or no tax jurisdictions, will obviously have to be relooked, because the exemptions might not be there, since the taxation is not there in certain jurisdictions, for example, the British Virgin Islands, etc. Maybe have the next slide, please. Coming to the branch profit, and this is basically catering to a UAE entity having a foreign branch, for example, in UK or the Kingdom of Saudi Arabia. Two options have been envisaged. First is you pay tax, you include those incomes in your computation of income, and you pay tax. And simultaneously, you take credit of the taxes which are paid outside under the unilateral way of the corporate tax law, or maybe if you have the treaty present, the tax treaty present between the concerned nations, then you may evaluate the option which is there in the tax treaty and apply whichever the beneficial provision is. The second option has been given to claim an exemption from the branch profit. However, it comes with certain conditions. The option has to be exercised for all the foreign branches, so there is no cherry picking allowed, as we see from the public consultation document. The option is irrevocable. Once you opt in for the exemption has to remain for life. You cannot opt out. And the third condition, and very important condition, is the foreign branch should be subject to sufficient level of taxation in the foreign jurisdiction. What qualifies as a sufficient level of taxation in foreign jurisdictions? Much clarity is awaited in the decree law and the executive regulations. However, when choosing between the two options is concerned, a due diligence has to be placed, a business case has to be made, because here two options can be considered. First of all, we see how many branches we have, whether those branches are actually subject to sufficient level of taxation in the foreign jurisdiction. If at all taxation is there for the foreign jurisdiction branches, etc., whether we have a treaty provision in place which gives a credit or an exemptions, etc. A business case scenario-based analysis will have to be made before taking or opting for either of the options. So that was on the foreign branch profits. Of course, where we discussed all the concept, the salient features, it would be aligned with the cross-border issues to be read along with the tax treaty provisions, which will be discussed in the ensuing slides. Maybe have the next slide, please. Yeah. Coming to the computation of the taxable income, what we have tried is we have tried to give you a sample statement of the computation of taxable income, where we discuss some disallowances, some exemptions, and any other adjustments, and how we arrive at the taxable income. We start with the accounting net profit, which is stated in the financial statements complying with the international standards. We do expect some relaxation for the SME segment. However, the SME segment has not been defined, and what kind of relaxation we'll have to wait to see what kind of relaxation has been proposed. Assuming the relaxation is not there and the statement is complying with the international accounting standards, commonly the IFRS applied in UAE, we start with the net profit, we make certain adjustments, and certain disallowances have been spoken from the unrealized gains on capital items, the interest expenses beyond 30% of your earnings before interest, tax, and depreciation. Interestingly, this concept has been borrowed again from the international arena and coming from the base erosion and profit shifting approach, where there is a limitation to the interest expenses because it might be seen to avoid taxes when the interest expenses are tax deductible in one jurisdictions and not taxable in other jurisdictions. So there is a limitation and commonly referred to as the thin capitalization rules. However, again, some relaxation is expected for the SME sector as far as interest expense limitations is concerned. The next example, which has been given around it, entertainment expenses beyond 50%. Balance 50% would be disallowed, citing some personal element to it. And the definition has been kept wide open as far as entertainment expenses are concerned. Then we have the common disallowances which we see around the globe on fines, penalties, recoverable VAT, etc. Some personal expenditure, of course, those would be disallowed. Some capital expenditures, which are having a huge capital expenditure in the profit and loss, having benefit not only in year one, but which spreads to subsequent years as well. Those expenses would be expressly disallowed. Some prior period items which are not actually the expenses of that particular year, but arising because of the errors or omissions in the prior years, and the expenses which are not linked to your taxable revenues. So we are definitely going to have some express disallowances in place. And as far as exclusions are concerned, the way we discuss dividends, capital gains, and foreign planned profits might be excluded from the computation. And certain other type of adjustment, if at all we see some special allowances or special incomes, etc. In case basis the public consultation documents and the comments from the consultants and the industry, the law might have certain special allowance, etc. Some adjustment will have to be made. And this is where we arrive at a net taxable profit, and we apply the tax rate of 0%, 9%, or likely 15% coming out of the global minimum tax project of Pillar 2, which we will see when the decree law is published or the executive regulation is published. Maybe you have the next slide, please. Yeah. Coming to the tax computation of the tax liability, simply stated, we start with the net taxable income. We compute the tax 0% up to 375,000 dirhams of net profit, taxable profits. Beyond 375,000 dirhams, it's 9%. There might be a different rate in case you qualify for the global minimum tax project Pillar 2 approach. We arrived at the total corporate tax liability. We take the credit of foreign tax paid outside UAE, which will be discussed in detail in ensuing slides, and then we arrived at net corporate tax liability. Yeah, maybe have the next slide. Certain key administrative aspects. We start with the registration. We have to approach the federal tax authorities and obtain the tax registration number. This may apply to the free zone entities as well, because per se they are within the scope. However, the exemptions are still there. They will have to apply, obtain the tax registration number. Then comes the compliances, where we compute our tax liabilities. Sufficient amount of time has been envisaged to comply with the provisions to file the return of income, which is 9 months from the end of the financial year. Then comes the assessment. Once we file the return of income, there would be an assessment from the Federal Tax Authority. In case everything is fine, the assessment may not be modified. In case federal tax authorities have queries, etc., the assessment may be modified. And in case of modified assessment, there is an option to challenge this assessment by way of appeals. So a litigation process might follow in. One of the important aspects which we see in the public consultation document as far as administrative aspects is concerned is about seeking the binding clarification from the Federal Tax Authority. This is something similar which we see in the mature tax jurisdiction, commonly referred to as advanced ruling, where we can approach the tax authorities on certain issues where the tax treatment is not clear. So we have the option of approaching the federal tax authorities. There might be clarification from the Federal Tax Authority, and those clarifications are then binding on the taxpayer as well as the tax authorities, etc. And certain documents would again be prescribed for some special cases, specifically for the free zone benefiting from the 0% corporate tax rate. So thank you. That was it from my side. I will just hand it over to Ms. Lydia.
Thank you very much, Vineet. And first of all, I would like to apologize. I think there were some sound issues that some of the participants were facing. But if there's any concerns regarding the slides presented, we will address them surely. So moving on to the next slide, I would like to introduce Mr. Manoj Pandey, who is the final speaker for today, who is our COO of our Abu Dhabi office and senior partner for tax for the entire MENA region. He leads the tax practice in UAE and GCC, specializing in development of tax strategies, transfer pricing, BEPS, cross-border taxation, and M&A services. He's a chartered accountant and comes with more than 20 years of professional experience in direct taxes. So Mr. Pandey, please take the decision forward.
Thank you so much, Lydia, and very good morning to all the friends who have joined. So thank you, Vineet, and thank you, MBG, for giving the broad introduction about the tax framework. So now what I'm going to touch upon here is about the concept of international taxation and some free zones here. So I will talk about what kind of incentives are available, exemptions are available for the free zones. So let's say for a free zone, persons are the persons basically who are registered in a free zone. So that is a condition number one. Tax incentive is available at 0%. That means they don't need to pay any taxes. Now, important point here is for a free zone person is that, generally a free zone is structured for a defined period of time for which, the tax exemptions are available for 50 years or, let us say 50 years. And if the free zone is already in existence for 27, 28 or 30 years, that means the corporate tax exemption is going to be available only for the remaining period, which is 20 years. So this is a very, very important point for all the entities in the free zone, that you can enjoy the corporate tax exemption only for the remainder period. That is whatever is left out. So that is something that we need to study, for each free zone. For other condition for having a 0% tax in free zone is that it should be compliant with all the regulatory conditions as is imposed by free zone authority. So whether it means auditing, whether it means an IFRS, or whether it means following procedures of having the board meetings, etc., or for the visas or the labor compliances, all those compliances has to be ensured in order to enjoy the exemption. The third and very important condition is that the free zone entities needs to prove a substance. Now, when it comes to substance, we have seen previously in the ESR laws that only 9 activities were subject to the ESR compliance. And out of those 9 activities, the manufacturing activities and some other activities were not part of the ESR compliance. So we need to, but here in case of the free zone entity, all the entities, whether you are structured as a holding company or whether it's a holding some operating company or whether it's a manufacturing entity, all the entities will have to prove a substance in order to enjoy exemption. For a manufacturing company, substance is generally automatic, but the circumstances or a scenario where an entity is doing a contract manufacturing, there is a possibility that substance may not be available. And fourth and last condition is that all the entities are subject to annual audit. So annual audit is a mandatory condition for a free zone entity. And as my colleague has said that, once you opt for a free zone, then you cannot be, either covered under a group registration or you cannot carry forward the losses because you're already claiming an exemption. So from that perspective, free zone is very relevant here. Now there are some certain transactions which have been classified as exempt. So those transactions are basically if a free zone person is transacting or having a passive income from its subsidiaries here in UAE, those passive income generally we call it as a dividend income, interest income, or a royalty income. Those incomes are will not be having any impact on the exemption. So you can continue to draw the passive income from the mainland. The transactions with the group companies, per se is permissible. Now here group companies typically will mean that, holding subsidiary companies. It also can mean associate companies, or it can also mean a company with a shareholding of 50% and above. So that group or branch office can also be included. So all the group company will be part of entities, and you can do transaction with group company without having any implication. But of course, for a group company, if it makes any kind of a payment to a free zone, then the expenses will be disallowed in its hand. Second kind of a transaction for a free zone is that they can do trading activities within the free zone or with other free zone. So all those trading transactions are permissible. This also means that the service transaction within the free zone or with other free zone will not be permitted. Further, if a free zone is regarded as a designated free zone, and if there is a buyer in the mainland and a buyer is an importer on record, then in those circumstances also, a free zone person can transact with the importer on record without having any impact on the exemption. So outside UAE, all incomes are exempt. Within UAE, certain incomes will not have any impact on the exemption. And lastly, we have to ensure that the free zone person is compliant with the conditions that are prescribed in the law. So that is it for the free zone. If we see transitional rules, these are also very important. The law as of now says that all the entities, they are not supposed to reinstate their balance sheets. So let us say for your entity, if you are going in with a corporate tax framework in 2024, the opening balance sheet for December 2023 will be accepted as it is, number one. Secondly, that the transitional provisions will be coming in, and we have to be very particular about those provisions. Especially, I'll give you an example. Let us say you have a bad debt, and those debts were actually prior to the corporate tax regime, and you decide to write off those debts, in the post corporate tax regime. Whether those write-offs will be allowed as an eligible expense? The answer is no, because the debts, when you recognize the sales, at that time there was no corporate tax. So accordingly, when you write off in the post corporate tax regime also, there will be no deduction. So all these aspects will have to be carefully looked into, and it also will make sense for entities if they are carrying over any kind of qualified opinions. It will make sense for them to revisit those opinions so that it doesn't impact their implementation in corporate tax. Further, if there are certain principles, accounting principles, especially with regard to the IFRS, like for example in insurance sector or any other aspect, then that is something which needs to be followed in principle and should not be having any deviation on that. So all these transitional rules will be very important and will have to be duly looked into before you go into the corporate tax. And the cross-border concept. So cross-border concepts here you see is with regard to the inbound and with regard to the outbound. So as we understand it, all the resident entities, they are subject to the worldwide income. So when we say worldwide income, it typically means that the income that you generate from your export revenue or the income that you have from your branches, that we call it as a worldwide income. But there are certain structures where an entity here in UAE may have a subsidiary company, let us say in KSA. But UAE entity is regarded as a headquarter or a regional headquarter where all the management for all the region, whether it is KSA, Bahrain, or Oman, or if all the management is sitting here, let us say in Dubai, and they are taking all their decisions through a virtual meeting, or they are signing contracts sitting here. In those cases, there is a very high, there is a concept, we call it as place of effective management. And in those cases, even the overseas subsidiaries, even though they may be paying taxes in those countries, can still be subject to tax here in UAE, citing that the management is actually situated here in UAE. So all the entities or the holding companies or the regional headquarter businesses will have to look into, revisit the structure to see how they are, conducting their businesses in the region, where the decisions are taken, how the minutes are being prepared, who is signing the contract, what is your travel arrangements in these countries. So all these do's and don'ts have to be carefully looked into to avoid any kind of taxations happening here in UAE. Now, I would also like to cite here that the UAE tax authorities, they can voluntarily on their own register any overseas entity. So if they feel that the overseas entity is subject to pay taxes in UAE, they can do and they can register on their own. So let us say tomorrow if there is any news in a public domain which says that management of an X entity here they have signed one contract in UAE or PSA. So this will give a trigger to the tax authorities to look into the structure of this particular entity and maybe bring to tax the PSA entity here in UAE. All these aspects are very, very important, and with the spread of information that we have through the digitization, there is a wider risk, and all the entities needs to be very mindful of the possible tax exposure that they can have. So this is all we have to be very careful on the OM side. Now, the guidelines are there. They are basically around how the meetings are conducted, how the affairs, how the business are structured, who is taking the decision, whether the quorum is there or not. So we need to take guidance. Either those are there in ESR, those are also there in the local laws, and it is also available in various, case laws that we have for foreign countries from UK, US, India, and other developed countries, where this concept has been dealt in very detail. So it is all around how the business is structured, and minutes of board meetings, the employees, etc. are very important when we decide. And of course, the tax residency certificate is also very important criteria. Now, a permanent establishment. This is a permanent establishment, basically a concept which is could bring to taxation the overseas entity. To give you, let's give you an example, entity, let us say in Japan, they do have some offshore supplies to, let's say, ADNOC here in Abu Dhabi. In those cases, if the overseas entity, Japanese entity, they are regarded to have a permanent establishment in UAE because of the travel arrangement, or because of their dependent agent, or because they are having some kind of an office here, or their people are stationed here, and that is quite permanent in nature, where all the business decisions are taken or business is happening, then that could expose the foreign entity for even a taxation on offshore supplies. So even the the foreign company may say that it is all supplies are being made from outside UAE and they have nothing to do here in UAE. But this permanent establishment is a concept which tries and builds a nexus of those offshore supplies with UAE, and then the tax authorities can bring to tax even the offshore supplies here in UAE. Here again, the information that are available in public domain, or information that tax authorities can obtain for for the resident entities, like it could be ADNOC, it could be Allah, or it could be any other entities in the infrastructure sector, in the oil and gas sector. And if they feel that the overseas entities, they have a permanent establishment, they have nexus, and they are regularly doing business by stationing here their employees, then there could be a very high risk exposure for the foreign entity to pay taxes in UAE. Now, if you see what actually means permanent establishment, there are certain concepts. We need to go to those concepts, and those are principally around two basic things. If you go to the next slide, Rahul. One we call it as a fixed place P, and the other is agency P. So fixed place P, we have place of management, branch, office. Now you see office could be your actual office, registered office. It could also mean an office if it is a house of an employee is used as an office. Even a customer place can be also regarded as an office. Even let us say an oil rig, which is here for an overseas entity, if it has a real estate property, it can also be regarded as a permanent establishment. So anything which is over and above stationed here for a period of more than 6 months, typically 6 months is what they have defined here under the public consultation document, that could be regarded as having a permanent establishment. But with our prior experiences, we have seen that even for a very, very high value transaction, even if the tenure is less than 6 months, the tax authorities will try and bring to tax such transactions. Now, agency P, in the agency P, only the dependent agents will be regarded as having a permanent establishment. So when we say dependent agent, we have to also look through the lens, we have to look through the glasses and tend to ensure there could be a scenario where an independent agent can also be regarded as a dependent. I'll just give you an example. Let us say you have a distributor, foreign entity has a distributor here, but all the employees in the distributor, they all are appointed by the foreign entity. Then let's say all the employees in the distributor's arrangement, they are taking instructions for the foreign entity. In such a case, even an independent agent can be also regarded as a dependent one, and there could be a permanent establishment. But just one principle that we need to look into in case of agency P, that the agent should be financially dependent, economically dependent on the overseas entity, number one. And number two, that he should be habitually concluding contracts on behalf of the foreign entity. So habitually concluding contracts, or he should have taken a material part in negotiating and concluding those contracts on behalf of the foreign enterprise. So let us say if you have agent here, the agent goes out for all the meetings, he decides the pricing, he decides the discounts, he decides the delivery terms, he decides any changes in the key terms of the contract, and in all the minutes of the meeting, the local customers, he's a part of those meetings. In those cases, tax authorities can regard such an agent to form a permanent establishment for the foreign enterprise, and foreign enterprise could have a tax exposure. The worst part in this permanent establishment risk is that generally all the tax authorities, they dig out these cases 3 or 4 years after the transaction has happened. If case permanent establishment is discovered, then it also comes with huge interest and penalty exposure. So therefore, it makes sense for the foreign company to make sure that their structure are very well defined, their activities are well defined, their scope, what each one has to do is well defined, and they understand that what could be the possible risk of a permanent establishment. Now we go to the other concept, the form of presence for foreign enterprises, all the liaison offices, rep offices which are not allowed to carry out the commercial activities, they'll be under very close scrutiny. So should be very sure that they are not undertaking any commercial decisions on behalf of foreign entities, and they are not part of the key meetings. And wherever if they are, then either those entities or foreign entities needs to reconsider conversion of liaison offices to the branch offices or to set up a LLC entity. Same way, agency arrangement, exclusive agency arrangements will be very important and critical. Employer reputation and temporary offices, whether hotel premises or any customer premises, if they are being used on a continuous basis for a period exceeding 6 months, then it really poses the foreign entity for a great degree of risk. Now on the next slide, if you go down. So foreign tax, basically this tax credit is eligible to the resident entities. Foreign enterprises have nothing to do with it. So foreign tax credit is available only to the resident entity. So when we talk about resident entity, you would have seen that many entities in this part of the world, they are just being created to take the tax advantage. But if those entities are not having any such stance, if their people are not here, they are just being used as a conduit, as a pass-through entity, there is a high degree of risk that they may not be regarded as a resident, and then the foreign tax credit may be denied. The other important point here is also the fact that when you have to take a foreign tax credit, all the documents, the tax payment in the overseas countries, they need to be properly collected. It needs to be translated, and it also needs to be notarized in order to enjoy the tax credit. We have seen from our experiences where there is a differences in the financial year, where the tax returns are not filed in the overseas country, and we are going ahead only to take the credit based on the withholding tax certificates. those issues are create very high risk, and they pose a lot of problems for the resident entities to create to claim the foreign tax credit. And let's go to the next. So transfer pricing provision. So transfer pricing, they have defined what do we mean by related parties. They have defined what do we mean by connected person when it comes to domestic transfer pricing. So here domestic transfer pricing is also applicable. International transfer pricing is also applicable. So when you're transacting with free zone also, there also we have to be very careful. And when you're transacting with any shareholders, directors or officers, you have to be very careful that those transactions will be under the close scrutiny of tax authorities. Now there could be a possibility whenever we have to deal with transfer pricing, there could be a possibility that structuring or some arrangements are done in order to avoid the taxes. So tax authorities, they are very serious on these things, and all the transaction related parties has to be very, very seriously looked into. Proper documentation have to be there in place, and the proper benchmarking and the pricing has to be in place. So I would like to draw your attention in cases where the entity is predominantly doing only transaction with related parties, or an entity which is making losses here on a continuous basis, and they have a high degree of transaction with related parties. So here the tax authorities, they have a question that what is the fun for you to do business here in this part of the world with losses? So in those cases, we have to be very careful. The losses needs to be justified. There has to be commercial reasoning, and then on that basis only, we as a consultant could be helpful to provide and substantiate that the transaction not at arm's length price. Approach, documentation, methodology needs to be very, very well documented. We have seen from our experience in other part of this region like Qatar from 2020 onwards, and in KSA, that tax authority is very difficult to benchmark the transaction. Sometimes the tax authorities, they take a view that the pricing is absolutely not correct, especially they are driven by the fact that the entity is either not making adequate profit or they are making losses. Let's go to the next. So here are typical example of cross-border. So let us say holding company outside UAE, it could have a mainland entity, it could have a free zone entity. So even a free zone entity, even though it is corporate tax exempt, but if suppose tax authorities, they regard that transaction or their revenue should be X plus Y or X plus delta, then in that case, the delta amount that could not be subject to tax exemption, and there could be a possible tax exposure with interest and penalty. Transfer pricing is not only applicable or important for the mainland entity, but is also applicable for a free zone entity, because in that case, the anti-abuse, we call it as provisions, could be hit. Let's go to next. So transfer pricing, as we just roughly talked about, like what could be the possible scenario where the risk will be high, and what are the ways and means in which we have to do transaction. I would also like to give one example. Let us say a simple example of buying with a related party. So an entity here, the mainland, they're buying from a related party, let's say in Japan or China, and they're giving a credit period of 1 year. So even forget about the price, forget about anything else. Here, even giving a credit period of 1 year could be regarded as a unfavorable transaction from a transfer pricing tax standpoint. And here the tax authorities, they can say that you have given a credit facility to your related party, and therefore some kind of a notional interest income should be taxed in your hand as a business profit. Let's go next. Well, in terms of compliances, you see there are 3-tier compliance requirements that are generally available, or rather we call it as 4-tier. One is that with the return of income, we are supposed to file disclosure form. So here the onus is on the taxpayer to disclose all related party transaction. Then there is a local filing. So local filing, all will have to be done in transaction wise, and it has to report the nature of transaction, nature of relationship, and what are the basis of this transaction with economic analysis. Master file is basically needs to be prepared for a structure and it is generally for our, intellectual properties or intangible assets for which we have to give also declaration, and of course the country by country reporting, which is a blueprint of the group transaction for a group which has a consolidated revenue of more than 750 million euro or 3.15 billion AED. So what we have seen is that, transfer pricing is something that it should be planned well in advance, right at the time when you do the transaction, and should not be left to the consultant, at the end of the year, post facto, when the transaction has already happened. Because once the transaction happens, and we as a consultant cannot help much. But it will make sense for all the taxpayers that they come in advance, they review their structure, they review the transaction, and ensure that whatever transaction is related parties are at arm's length. Right, that's it. So I think the OECD Pillar 2 framework, I think this is something global minimum tax we have already talked about, my colleagues have talked about. So here the tax rate will increase from 9% to 15%, and it would be typically for those companies who are under TCDCR framework. Okay, next. Tax treaty is very important because sometimes what happens that we can have a wider definition under the law, and those definitions can be narrowed down with the help of the tax treaty. But of course, in order to enjoy the tax treaty benefit, one has to be a resident, and one has to also comply with the conditions as prescribed in the treaty. One thing I would like to state here that many tax authorities, they refer to the OECD commentary, but OECD commentary, they are not binding on the tax authorities. And now with the G20, they have also introduced a new concept, we call it as MLI or multilateral instrument. So this is a new instrument which can automatically ratify, the tax treaty. When you have to read the tax treaty, you have to read the domestic law, you have to read the tax treaty, and then you have to also read the MLI that UAE has signed. And just for information, UAE has already signed the MLIs and is a part of that MLI network of 130. So our value proposition, you see, we are already started working with so many of our clients where, they want to understand well in advance that what could be the possible tax exposure for them. Because as we see, it will look like, it's very easy. It's a 9% of your accounting profit, but technically speaking, it may not be 9% because there could be some expenses which are not allowed, some expenses which could be partly allowed. There could be transactions with related parties. Those related party transactions may not be, allowed. There could be foreign tax credit. There could be whole lot of issues, payment to connected persons, payment to free zone, whether those will be disallowed. So one has to understand as to, first, what would be the impact on them, and then whether those impact can be restructured either by following a different route, different structuring, different strategy, different supply chain, different arrangement. And if it is available, then we have a very lesser time to implement those recommendations. And whatever implementation or recommendation you need to implement, it will also may come with the cost. So we, have to suggest something which is also cost optimized. And of course, in phase 3, we can also implement the first year filing with all those, provisions in law, and then you can help the companies to be tax compliant also and file returns for year 1. So that is it from our end, and anything or any questions we have, we'll be more than happy to answer.
Yes, we have received a lot of questions, in fact, but in the interest of time, we would not be able to take more than, a few of them. So there is a question which I feel, I think, Mr. Sachdev, I think you would like to take this question. So one of our participants has asked, do you feel that the proposed tax regime in UAE will be easy to comply and will not attract disputes on larger business areas?
Okay, yeah, thank you. It's an interesting question. Well, there are two important aspects to answer it. One, as much as we see, the law in its present shape and form is comparatively simpler to what we have in other countries. Other countries, the mature tax jurisdictions have very complicated laws because there are multiple transactions. And sometimes transactions are stretching between different enterprises, connected or unconnected. So having done that comparative analysis, we feel that here things would be quite simpler. There are no provisional tax filings, there are no provisional payments. Everything is simple and sounds quite straight. In fact, the filing obligation is also after the year gets over, within 9 months, you have to complete your filing and pay your taxes. The best part is that you have sufficient time to prepare and restructure your businesses. A full-fledged 1 year is in your hands. Well, the other aspect, of course, government on its part is trying its best to ensure removal of any kind of uncertainty on the transactions and businesses. But tax laws globally are meant to be a bit complicated, and there are many important aspects where revenue authorities and businesses have difference of opinions. So disputes may come, but I am sure with passage of time and proper preparations, all possible attempts can be made to mitigate those disputes.
Thank you so much, Mr. Sachdev. I think that really gives a clear perspective to our participants. One more question. I think you also talked about it in your part. What are the 3 key areas that you would suggest business to be planning in advance?
Yes, it's very important actually. One is to carry out a proper impact study as to how businesses and the transactions would have to be aligned with the corporate tax. That's one important aspect. Secondly, proper compliance should be very, very important to manage disclosures and reportings in corporate tax in a year from now when it comes into force. And third is we should have a very clear segregation in terms of business and non-business expenditures, because anything which is outside business would not be permitted as a deduction for calculating taxable profits here in UAE.
Thank you so much, Mr. Sachdev. I think now we can take one question for Mr. Pandey. So, Mr. Pandey, there's a question from a participant. He asks, will there be any refund in UAE for withholding taxes suffered by a company, say in Saudi Arabia?
Right. So here in this case, like if you have suffered a tax in Saudi Arabia, the taxes are paid to the Saudi government, and UAE government as such has not received anything. So therefore, there is no question of getting any refund in UAE. What maximum you can get is you can get the adjustment of those taxes against your tax liability in UAE.
Okay, sir. There's one more question. So the participant is asking, will all cases of exclusive agency agreement would have a PE exposure?
In case of exclusive agency agreement, of course, all cases will not be subject to the PE exposure. But what we need to see is that, what is the role of those agents in concluding contracts on behalf of foreign enterprises? So how they are functioning in this part of the world? What is their role? To what extent, they are going ahead and deciding on behalf of the foreign enterprise? That will decide whether those exclusive arrangements could have a PE exposure.
Thank you so much, Mr. Pandey. So we can take one last question, and I think Vineet would be, the right person to answer this. So will it make sense for an entity to change financial year to defer the applicability of corporate tax?
So this is a common question. I think many business houses are considering, or may at least at the evaluation stages, where the applicability starts in 23 and not in 24, if at all it's not a calendar year. The answer to this question lies first in the business case and the facts which are presented, of course, differing or changing of the financial year gives you a buffer period for planning purposes and a deferment period for corporate tax purposes, etc. But the question more would be from a legal side as well, whether your company law permits you to have the change, your memorandum permits you to have a change in the financial year, etc. So question lies there, first, whether there is a business case for a change in financial year, because there would be a deferment, but deferment only for a few months. However, again, if a good amount of time is required for planning, then the legal framework will also have to be considered for changing the financial year, specifically the company law and the memorandum, etc. How fast you can change all the legal framework and the memorandum documents, etc. Because the processes will also have to be changed, etc. So a business case will have to be there.
Thank you so much, Vineet, for clarifying this for our audience. So I think with this, we come to the end of Q&A, and I would like to thank all our speakers, Mr. Sachdev, Mr. Pandey, and Mr. Vineet, for giving us a detailed overview of the corporate tax which is being introduced in the UAE from June 2023. In case you have any further questions, and this is to all our audience, if you can please put in the chat box 1, 2, or 3. So either in the chat box or in the Q&A box, along with your email address. So if you are requesting for a one-to-one meeting with our team members, if you want to request for a workshop for your entire organization, or if you have any further questions on corporate tax, please put these options in the Q&A box, 1, 2, or 3, and also share your email address. Our team would come back to you, with a suitable time when they can, have a virtual meeting or a in-person meeting, or conduct a workshop for your organization. So if all the participants can do that, we will take down all the requests. Just to kind of give you an idea of where MBG will be participating in the upcoming weeks. So on the 12th of June, the Institute of Chartered Accountants of India, Abu Dhabi chapter, would be organizing a corporate tax symposium at Dusif Thani, Abu Dhabi. This is on 12th of June, Sunday, 9 o'clock onwards. And we have, again, Mr. Amit Sachdev, CEO Direct Tax. He would be a speaker. And Mr. Janardhan Singh, who is COO Direct Tax, he will also be a speaker there. So in case you wish to register, please go on the ICAI Abu Dhabi website, and you will find all the details there. With Khalij Times, which is the leading English newspaper in the UAE, we are proud to be the knowledge partner for the corporate tax webinar. This is on the 20th of June at 11 a.m. Again, this will be a virtual session. So to get all these updates regularly, please subscribe, please follow our social channels. You would see the links in the Q&A and chat box for our LinkedIn, Instagram, YouTube pages. And if you follow us on social media, you will get these updates from time to time. So thank you once again for joining us for this session today, and we look forward to conducting more such knowledge sessions in the future for the benefit of all. Thank you once again to all our esteemed speakers, and thank you to the audience. Have a very good week ahead.